great to be here. I'm Taylor Ingram. I'm a partner at ASC Advisors. We are a strategic communications we're a strategic communications firm that works exclusively in the alternative investment management space, primarily private equity, hedge funds. So today and tomorrow is kind of right up our alley. Today I'm excited to be here with a couple of great panelists to talk about a pretty important topic. I think something that's been really topical over especially the last few years, and something that's gaining a lot of momentum is liquidity issues within private equity and the alternatives and options that both LPs and GPs have to kind of address those. So to start, I'll let you guys each introduce yourselves. And I think the interesting thing about this panel is that each of us up here have worked with different participants in the market, whether it be LPs, GPs, institutional, high net worth, whatever it might be. But so there's a number of different ways and levers that they can each pull and work with different people in the market. So John, you want to start and introduce yourself and Devon Park?
Sure. John Costello, Managing Partner of Devon Park Advisors. We're a boutique investment bank based here in West Palm. We have 15 full-time professionals, and we predominantly represent sponsors in continuation fund transactions. For those that don't know what continuation funds are, we'll talk a little bit about that later, but it's basically giving a sponsor the opportunity to hold an asset significantly longer than the current fund life. And we tend to work across asset classes, so private equity, private credit, private real estate, and private infrastructure. And a typical fundraise for us in this context is between $100 million upwards of $1 billion.
Great, Seth Drzinski from Bank of America, private bank, and what I'm representing is really offering credit solutions for ultra high net worth clients and really accessing liquidity for their LP interests, and doing that from an overall sort of balance sheet perspective, recognizing that asset class continues to expand as part of their overall investment strategy, and the need to get liquidity off of that. So that's where I'm at.
I'm Brad Hepner, and I want to thank you, John, for having us here at the conference. Good to see everyone. I'm the CEO of Beneficient. We are a publicly traded company that is a fiduciary financial institution, which is a trust company. We deploy our balance sheet, providing liquidity to limited partners and general partners in private equity, and we also provide qualified custodial services, transfer agency services, broker-dealer services, for the transactions of limited partnership entities.
Great. And I think to start, it would make sense, and John, you touched on this a little bit, just to give a little bit more depth on kind of what some of these liquidity options and alternatives are. And John, if you want to start and kind of walk through the continuation market and kind of where you're seeing demand recently, and kind of how I think the LP the LP base is starting to come around a little bit more to these types of products, and the opportunities for both the GP and LPs on those. So if you could start there, and then I think Seth and Brad, if you guys could jump in and discuss how the different types of things that you're seeing and what those alternatives are.
Sure. So it's a little bit different than what my colleagues here are going to talk about. We tend to work with assets. So our clients have created a company or a series of businesses that, for a number of reasons, they want to continue to hold them for an extended period of time. And for those that have been in this industry for a while, there was at one point this theory that you could create permanent evergreen long-dated fund structures. And institutional investors really didn't resonate with them. And so about 10 years ago, there started to be transactions to allow sponsors to take a specific company or a series of companies out of one or more funds and create a new investment product that they would manage. So they own it today and they are buying it from themselves. And as part of that transaction, they're offering any existing investor in their funds a liquidity option at a value based on an auction process that we run. And so it could be a portfolio of residential real estate assets. It could be, we did a deal, following on the other panel, we did a deal on a set of California peaker power plants a few years ago. We recapped the third largest owner-operator of car washes about 2 years ago. It kind of doesn't really matter what the underlying asset is. It's, what we do is we help find the capital to give that replacement liquidity to any investor that wants it. And then as part of the transaction, our client usually wants to buy a bunch of other things that are either add-on acquisitions or maybe they want to buy out another partner in the business, and we raise incremental capital for that specific strategy. So it's just a highly focused product that a lot of institutional investors, they really like. It's just to put it in perspective, this year there will be about $70 billion worth of these deals in North America. So it's a pretty substantial market.
And, yeah, Seth, do you want to?
Yeah, you know, from a private client perspective, I mean, what we've seen over, you know, a period of time is allocations into more liquid investments, right? And you know, as those investments continue to grow in size on clients' portfolios, they're also looking for access to liquidity. You know, traditionally, we've been able to source that through, you know, if you think about marketable securities, other things where people are looking for leverage or that liquidity without selling assets. You know, what's come apparent is the need to start to think about this asset class and being able to lend against it directly for these individuals. And, you know, within Bank of America and the private bank, I mean, we take a, you know, holistic view of clients and looking to understand what their direct needs are. But we've seen that. And then when you see, you know, less of the liquidity or the you know, if you have these add-ons or the market not resulting in exits, that gets a little bit exasperated. And people are looking for that liquidity, and that's where we're looking to provide support and doing that in a more defined and regular basis.
Our view on it is that the continuation fund is becoming a more dominant percentage of overall liquidity. And the continuation fund is principally supported by your largest of institutions that can afford the timeline and extended timeline. So to Seth's point, we have a market that is developing that is the family office, the mid to high net worth individual who has been sold into feeder vehicles or into these funds, and they are demanding the liquidity. So in the auction process, to get them the liquidity is becoming more and more of a pressure for them to come out of the continuation funds. I agree that this is becoming a much larger share of the market. We're going to approach total liquidity. We're going to be north of 140 billion this year, which will be close to our high from 2022. That's still low, y'all, because that's only about 5% of total net asset value by institutional managers in about 6,000 funds in the United States. 5% turn is a very low turn. There's structural reasons for that. Structural reasons include PTP issues, publicly traded partnership issues, where there can be taxation on the underlying fund for turning their investments or their limited partner positions too quickly. So it keeps that number low. So if we had a change in our tax law as it relates to PTP, that number could be north of 15% or 5 billion. And a lot of it would be run by the continuation funds. I do think John's number is low because the continuation funds we see are not only just single asset, but many times it's a single asset that represents 90% of the total net asset value, and there'll be 2 or 3 other assets tucked in with it, and yet the bankers only report the single asset continuation type vehicles. And so I think the number's even larger in this regard. So the summary is it puts the squeeze on the smaller investor. The investor who has less than $1 billion balance sheet, less than 200 million allocated to investments, and they're in these long-dated funds, where they really sold these thinking they were going to get most all their money back within 10 years, and they're now in the 12th or 13 years. I've been in the industry since 1989. The idea of a continuation fund to me is simply an extension of the limited partnership agreement, just another year extension to give the time to the general partner to realize the top asset in it. But it's a continuation fund is becoming a very dominant portion of the market, and it's putting the squeeze on the smaller investor who needs their liquidity out.
And Brad, I think on that note, what are some of the other, exits or opportunities, and how is Beneficient, for one example, offering that type of liquidity to those smaller investors?
The smaller investor is represented by a portfolio of investments that typically is under $2 million, and they'll have 3 or 4 holdings overall, or small institutions that are billion-dollar balance sheets and they have a portfolio of about $200 million. And so they don't command the $100 billion plus transactions. The average size of transaction in the secondary market is $150 billion. And so transacting as a small investor, you don't garner the attention of the people that Devon Partners takes the opportunities to. Or Bank of America is out there looking for these individuals to gain them liquidity in very small positions. So we call them low dollar amount and high volume. There's nearly 1 million households that hold these positions in the United States. It's over $600 billion in net asset value held by the individuals. So to address them, we need to have a simple approach because they don't have the money to spend on lawyers, a tax accountant, and their record keeper to transact. That cost can be equal to their net asset value investment. So what is needed and what Beneficient has delivered here is a regulated approach. We went to banking regulators and we said we need to create a regulated company that has regulated forms that are non-negotiable and that can be closed in 15 to 30 days as opposed to 9 to 15 months in an institutional transaction. Our numbers look really high for this first half of this year on secondary trades. Reason is it's driven by 2 big transactions. 2 very large transactions drove the secondary volume in the first half of our year. Individuals can't participate in that. And so with a regulated approach, with regulated forms, you can remove a lot of the intermediary cost. You can reduce, so you have a cost competitiveness. You can increase the simplicity by having plain English forms. And that is what the individuals are looking for. So it's a lot easier to then transact with a regulated entity right off their own balance sheet as opposed to a secondary fund. That's the avenue of, you got to attack the high volume, low dollar amounts of the folks that are getting squeezed.
And a couple of you now brought up and it's been mentioned a couple of times today, but the longer holding periods, the slower M&A market. As we head into a new administration, it feels like there's a renewed optimism about the M&A market generally. How do you guys both each see that impacting the secondary space? How are LPs going to, if there are increased exits and distributions, is the demand still going to be there? And where do you see the growth of the market going from there?
So the market is just, as Brad was saying, it's still pretty nascent, even at the size that it is. Most institutional investors today are still pretty well over allocated to alternative investments. So even if we get into a period of time where there's a more normalized exit environment, it's going to be several years before I think people still don't have some pressures to get liquidity. Now, obviously, we'll just see with interest rates coming down, bid-ask spreads and M&A deals are starting to compress, and more transactions are happening. But there is such a huge amount of embedded value sitting in these funds that I don't think it will slow the growth of the secondary market. If you look at it over the last 20 years, there was really only 1 year where volume went down, and that was right after the GFC. And the reason for that was that just what happens in the secondary market is because all of the reporting is lagged, it's at least 1 quarter old. In many cases, a lot of transactions are done off of 2 prior quarters. And so if there's a massive change in valuation environment, the secondary buyers basically hit the pause button and they wait for valuations to come down. Otherwise, they're going to bid you 60 cents on the dollar. And if they bid you 60 cents on the dollar, you're going to go sell something else. So you won't sell that single LP interest because you'll think that you're like giving it away. So there are periods of time where the market kind of like takes a pause, but it's usually like 1 or 2 quarters. You don't really see it dramatic. Even during COVID, during Q2 of 2020, there was a pause because no one knew what the value of these like private businesses were going to be. But by July of 2020, the market kind of rebounded, and in 2021 was a record year. So it doesn't take very long for this market to find equilibrium and continue to grow.
Yeah, I would say, you know, if you look structurally, right, investors continue to go into the space and continue to invest, and you almost end up with higher allocations. I think at some point you probably max out at some level, but that's continuing. And I think that just the duration of these investments, people are going to look for or seek liquidity against that. And that's really still nascent. I think that that's a still growing area. So you have folks that today maybe are looking for liquidity because the exits are delayed. But I also think that just generally speaking, as they make the investments, as they think about overall how they're managing their affairs, there's an opportunity to think about liquidity in a more holistic way, and I think that just continues on. So I do think while you have maybe some fits and starts and you have interest rates that will impact things, I think long term, this is an area that's going to continue to grow. People are continuing to seek liquidity against these assets in a variety of different ways.
Okay, I'm going to be very bullish. We are coming off of 24 months of historic low distribution ratios. We own, on our trust company balance sheet, we own nearly 400 funds diversified over the last 15 vintage years. If you look at endowment models across U.S.-based endowments and foundations, a typical year of a diversified alternative asset portfolio will generate a median of 16% of NAV in distributions. And that will fluctuate on a tight band between 14 and 18% each year. And so you factor that into your asset liability model. If you're a high net worth individual, you factor that into your cash flow model coming in. In the last 2 years, if you are a below median performer, you shut your distributions off. If you weren't a good fund picker, that 16% went to 0 for 24 months. They want distributions. Now, the opposite side of that is valuations did not come down. In fact, we're seeing valuation increases on NAV. So we have this big old pig coming through the snake. And on top of that pig of these unrealized assets, what we have behind that is more NAV coming down the line. And so economic policy that drive M&A, that drive IPOs, that's the reason the pig's stuck in the snake, okay? And so last Wednesday, there's euphoria in our industry. That snake is going to digest that pig in the next 12 days. These guys are going to be super busy because in the next 24 months, we're going to see that a neighborhood of $140 to $150 billion of transactions. That's our high kind of number. I believe and I forecast 24 months from now, we're going to be talking about $200 billion, and we're going to have another growing NAV come behind it because of the prior fundraising. Now, we're going to have another gap behind that because we're at pretty close to low fundraising rates for general partners of new primary funds over the last 2 years. I've been committed to private equity funds since 1989, and I'm glad to say the last 2 years is a segment of the economic cycle that I've never seen before, ever. And we're about ready to come out of it. And when we come out of it, I think it's going to be a pretty bullish boom of transactions and so forth. And that'll be all across private equity, including third and fourth quarter funds, if the economic policy does change.
We'll have to see. It's a lot of activity. I think, Brad, just staying with you for a minute, I'd love to hear kind of how you interact, or the LPs that you're working with interact with the GP, and how that transaction takes place. And then, John, conversely, I'd like to hear kind of how you're seeing GPs, essentially, how do GPs view LPs looking for liquidity? And then on the other side, how are LPs approaching GPs who are looking for liquidity? And how does that relationship?
The GPs are always accommodating to the limited partners, always. And LPs are, if you're a small investor, you just really have no leverage. General partners do not want to transact one-off liquidity requests. The reason is most all of them are formed as limited partnerships, and for tax purposes, they have to close their books and reopen their books when a new limited partner comes in. So they want to batch process those small transactions, which means as a small investor going through B of A who's helping you get liquidity, you may sit in the GP's inbox for a long time. And so what's important is that the liquidity provider have a direct relationship with that general partner and can help facilitate a transaction before the closing and reopening of the general partner's books. That's what's important. In other words, it cannot depend upon the general partner signing the assignment. There has to be an agreement to make the transaction happen, the limited partner get their liquidity, and then it'll be processed later. So to make that happen, you need a regulated entity to step in. You need a clearinghouse that steps in as a regulated entity. So there is an upper level role for a series of regulated entities to handle things, to remove the burden and the mess and so forth of the general partner, but to facilitate the needs of the limited partner. So to keep the general partner from having to have their administrative office be all burdened by these requests, that can be done by an upper level of regulated entities who do it all, and then the general partner does it at their convenience and facilitates it at their convenience. But the limited partner walks away with the liquidity earlier.
And generally, the GP is accommodating.
Yes, if they know if they know the intermediary, if they've signed up with the clearing corp, or if they've signed up for this. It doesn't cost them anything, but it helps to facilitate the transactions in a regulated manner.
Okay. And then, John, when you're approaching LPs about a continuation vehicle, I'm sure that the sentiment has shifted over the past few years, but kind of where are you seeing that relationship go? Are there new participants who are, or older LPs who are now becoming more receptive to continuing, or and what does that, what does that environment look like?
So, when you do a continuation fund, the liquidity provisioning is done as like effectively a private tender process. So everyone gets a set of election materials, and they have 20 business days to decide. And so there's parity of information between buyer and seller that's kind of governed by securities law. So everyone gets the same offer on the same day. They share the transaction costs to help mitigate what Brad was talking about, just the cost for an individual. Everyone gets their pro rata share of costs. So there is some bulk synergies in terms of running these processes vis-a-vis the LPs. The issue that LPs have with these deals is they don't really get paid to make these decisions. They get paid to allocate capital to managers, and they rely on the managers to decide when to sell investments. And what these transactions do is they actually transfer that burden onto the investor. And that's significant, more incremental work that they're not being paid for. And so as a result of that, they have to do more work. And there are just, right now there's 100 continuation funds in the US in market, all trying to raise capital, all trying to close in the next, they won't all close by year end, but in the next kind of 4 months. And so if you're a large institutional investor and you have a large portfolio of funds, you might have 50 new things that you have to decide on in the next 4 months at a very inconvenient time during the year. So a lot of large institutional LPs just don't like the incremental work. But what we find is that about 90% of the investors take the liquidity option. So, and that's kind of really increased since we got into this higher interest rate environment. It used to be about 60% of investors took the liquidity option. So we think that that is a function of the lack of distributions and the ability to just literally vote, click a box, and get your cash. And the default option is if you don't respond, you just get a wire and you're out of the fund. So it's become a pretty efficient process, but most institutional LPs don't want to be told necessarily what decision to make, and they would view a 20 business day window as a pretty short amount of time to make in some cases, a multi-$100 million decision.
And Seth, when you're working with your clients, how in depth are you getting on either a continuation vehicle that's brought to an LP, his high net worth LP, or if they're looking for liquidity on their own, what types of different alternatives and options are you?
Yeah, I mean, I think, the one thing that we have is looking at the profile holistically. And one benefit is, yes, they have a sleeve that's going to be related to the private equity interest, but we also have the opportunity to look beyond that and structure deals. So it is important, right? We're looking at, hey, when is this coming due? What's our expectation around the cash flows? What's the performance? Those things are all extremely important. And then putting a structure and the lending to go with that sort of expectation. But those are part of the conversations. But I think where we have, an opportunity is really to think about it, again, from that broader context, which provides us support and the capacity to be able to lend and meet the needs for these clients in terms of their liquidity needs.
Great. Another thing in the alternative space that we're hearing more and more from our clients, the investment managers, is there's a focus or more attention being spent paid to the retail market. John, I know I've heard you mention that there are retail-focused products that are capitalizing on the secondary space. Interested in how that's impacting the demand, impacting the supply and availability of these deals. And then kind of how that, if that's playing with you. I know, Brad, you're being a public company, are you positioning it as offering, access to these transactions to shareholders as well?
Yeah, so there's been a proliferation in the last several years of retail-focused evergreen alternative products. So I think Blackstone reported something like they raised $20 billion last quarter from just the retail channels into these evergreen products. And I think there's something like $6 billion a month flowing into retail alts. And it's not just Blackstone. There are specialist firms that are getting on this platform, and it's across asset class. And I think investors are particularly interested in the yielding versions. So that's why you've seen Blackstone's real estate, BREIT, Blackstone Credit. There's a number of smaller managers that have private credit offerings that are perpetually offered on retail channels. It's just, part of it is the institutions have been shut down for new commitments. And so private equity and alternatives people are smart. They go find the money. So they find the money with the retail channels. And this is a huge business for B of A, Morgan Stanley, Citi, all of these groups. And we don't see that going away. Now it's going to change because they're evergreen funds, it's going to change the complexion of how the secondary market operates, but they will have new capital inflows, and so that should provide more capital to create more growth in the market.
We've seen the registered funds the offerings that we're talking about in the past. And to put the numbers into perspective, this year is a high fundraising year, with about 90% of the number of funds that are in the market raising money this year. So this is a good secondary fundraising year. Registered funds that go to the retail market, that's what's offered out to the retail market, that represents about 5% of the total amount this year. But that's growing. As John said, it's growing, but it's only 5%. So it's not very large. Those registered funds have great constraints on them. They have to distribute their income out of it. They've got to maintain a level of liquidity for it. They've got to cross-match buyers and sellers. And many of us who've been in the industry for 25 years have seen several of these funds blow up and blow up. When somebody races to the door to get a withdrawal, it causes a run on the bank like the Jimmy Stewart movie, right? Everybody just, your money's fine, keep it here. It's not the way it works. It's a run on the bank, and the slow people are left with the worst assets at the end of the day. So I often caution individual investors from that risk. You better be on top of your fund, you better be watching the market, and you better put in your redemption requests or trade out of that fund if the market starts to turn on you, because you can be left with that fund having to sell assets, and you're left with the worst assets at the end of the day, and lawsuits and so forth. So we've seen that play out before, but the market's growing, and it's led by Blackstone. But there hasn't been any structural change. Nothing's changed at all. The capital continues to come in through the traditional secondary fund. We are a little different. We are quite a different beast in that we are a public company. We operate, our entire balance sheet is dedicated to financing people to buying their interests and taking them out of their alternative assets. And so we raise our money through the public markets. We have an effective S-1 registration statement that allows us to move stock into the market to fund our quarterly acquisitions and so forth. And we operate as a public company as opposed to a closed-end fund, which means we don't have the demands of making dividends unless the board elects to make dividends, which means we can borrow money on our balance sheet, which we do. We leverage our portfolio by about 30%. I will make one last comment. The expected returns on secondary funds on these types of investments is promoted by the managers to be a 1.5 times your money back and 15% rate of return. Now, all of us who have an HP 12C can quickly calculate that in and say, you know, that doesn't jive real well, because a 1.5 times in about 4.5 years, which is the average life, is only 10% IRR. And a 15% IRR is about 1.75. The purchase price of secondaries right now is approaching 90 cents on the dollar. Okay, so you're buying at a 10% discount. So if I'm supposed to earn 15% IRR in about 4.5 years, that means that 80% of my return, or 12% IRR, needs to come from the underlying asset, because the discount I bought at is only producing 18% of the return. That's it. It's producing a very small. So 4 times more of the return has got to come from the performance of the underlying asset. So that single asset continuation fund, it better generate at least a 12.8% IRR for me in the next 4 years. It better generate that for me. Otherwise, the price of the financing was too high. So valuations are up. They're up there back where we were 2 years ago, approaching 90 cents of net asset value. And the return expectations are too high, unless the new economic policy is going to drive a really attractive return on the residual NAV, which could happen.
And obviously all of that is case-by-case basis too, right? There's going to be the outliers. But anyway, I think we are beyond out of time at this point. So if anyone has any questions, please find any of us, and happy to continue the conversation. But thank you again.
Thank you.